the do's and don'ts of paying your spouse. And yes, business owners, we are talking to you. Hey guys, Mike back at it again with another great tax tip, strategy, the whole 9 yards. Make sure you hit that subscribe button to get the latest and greatest tax strategies for your individual life, your business, or a mix of both. All right, so today we're going to be going over paying your spouse, when it makes sense, some of the common misconceptions, and the reasons why you want to pay your spouse. So for all you business owners out there, before we rush to put your spouse on payroll, we need to weigh the pros and cons, cost benefit, to make sure it nets out that it's working for you and your spouse and your business. So some of the misconceptions when it comes to paying your spouse is a lot of business owners are under the assumption that if their spouse is not working in or for the business, they can still contribute to an IRA. Fortunately, that's not right. The other misconception is for Social Security taxes. And this is kind of twofold. The first side of this coin is that business owners think that their spouse is going to get a Social Security benefit, even if they're not working in the business, which is wrong. And the other side of the coin is, oh, I'll put my spouse on payroll and max out their payroll so they can max out their Social Security benefit when they retire. Why the heck would you want to pay more payroll tax for a benefit? Now, hang on, I'm not an economist or whatever they call it. I don't know if we're going to have Social Security benefits when we retire, but why the heck would you want to pay more payroll taxes now for a benefit that you're not going to see for a while down the road? I'd rather keep more money in the business pocket or your personal pocket. So Social Security, that's always a common misconception as well. So those are the two negative reasons, the cons, the common misconceptions, if you will. Now, for the good reasons, good reason number one is for retirement, the 401k plan. Now, this can be very favorable, especially for the solo 401k, if it's just the business owner and their spouse working. But if they have more employees, they got to get into more of a safe harbor 401k, but it's still on the table for the spouse. So this is a great pro because if the business owner and the spouse want to put a nice chunk of change away for retirement, then they both can double down on those contributions and also get the match at the business level and get the business tax deduction. And if it's a solo 401k, it's even more of a home run because there's more on the table to put away. Now, however, 401k, that's payroll. What comes with payroll? Social Security tax. Like I said before, we don't want to pay more FICA, more Social Security, more Medicare, but I'd rather pay more payroll tax if it meant I'm putting away more for retirement. From the employee standpoint, okay, I'll pay that 7.65% if it means I'm getting more than 7.65% in the market. That's compounding and compounding and compounding year over year over year until it's time to retire and take those funds out. Okay. Pro number two is to write off medical with an HRA, a health reimbursement arrangement. Now, the HRA, like the 401k and a solo 401k, is a discussion topic for another day. But the gist of the HRA is that the business gets a tax deduction and the individual gets a tax-free reimbursement for the most part. So let's draw this out quickly on the trifecta just to give a visual here. So we have our trifecta, we got our 1040 at the bottom or our revocable living trust. Now we're just going to look at this from the spouse's standpoint. Okay, so let's assume here we have the S corporation. Now, yes, the husband or the wife who owns the S corporation is going to get a K1 and a W-2 out of here, but we're just looking at the spouse for this example. So let's say the spouse is getting a W-2, got a W-2 here. With the W-2, they might be taking advantage of the 401k, which will be over here on the passive side. W-2 gets reported on the 1040. Now, the same thing for the HRA. S Corp pays out HRA and it flows down to the spouse, usually tax-free. Now, the right way really to do it with an HRA, and I've seen it in practice both ways, and a lot of CPAs tend to argue on this that, oh, you can pay it out of the S Corp or you have to do it through the family management company. I've seen both ways. The family management company is usually the cleaner route to do it. So we would get a family management company kind of right here. It's FMC, kind of like when you would pay the kids, kind of the same way. The S corporation would pay a reimbursement here, and then the family management company would pay the HRA out here. Now, I'm not trying to start any stirring the pot here. People can argue in the comments however they want to do it, show them both options. But the end goal is that it can be done. And if we really want to get politically correct, fine, I'll fix this. This would be more of a single member LLC that would pay the HRA fee and spit it back out to the spouse. Okay? All right, so the moral of the story, if you're planning to put your spouse on payroll, do your due diligence, do your cost benefit analysis. Be sure that you have your specific reasonings to support the 401k and the HRA, rather than just doing it because you saw a TikTok influencer talking about it. Okay, shots might have been fired there, but seriously, do your due diligence, do your homework, get a tax advisor in your court to help implement these and have discussions about these. Because if you can keep more money, not in just your pocket, but you and your spouse, rather than giving it to Uncle Sam, that's a win in my book.